The Bank of England is expected to hold interest rates at 3.75% tomorrow, and markets are pricing in 65 basis points of hikes by year-end. Both things are true at the same time, and that contradiction is the entire story. Oil crossed $107 a barrel on Wednesday as Trump instructed U.S. national security officials to prepare for a prolonged blockade of Iranian ports. The Strait of Hormuz, through which roughly 1/5 of the world's traded oil passes, remains effectively shut. UK gilt yields have surged, borrowing costs are rising, and the MPC is watching all of it, unwilling to move in either direction. The mechanism is what makes this moment unusual. A standard inflation shock calls for tighter policy, but this inflation is supply-driven. It originates from a physical choke point in the Persian Gulf, not from demand running too hot in Birmingham or Bristol. If the bank hikes into a war-driven oil shock, it risks crushing an already fragile economy. If it stays on hold while oil stays elevated, it risks second-round inflation embedding into wages and services. BoE Governor Andrew Bailey called the conflict a big negative shock at the IMF earlier this month. Analysts at SBRY expect the MPC to lean heavily into uncertainty language, maintaining what they describe as maximum optionality. The statement is expected to make clear the bank is prepared to move rates in either direction. That is not ambiguity. That is a central bank acknowledging it has lost the ability to forecast. UK growth was already weak before the first shot was fired. The IMF has since slashed the UK's 2026 growth forecast, the largest downgrade in the G7. Labour has virtually no fiscal headroom to cushion a higher rate environment. The FTSE 100 opened down 0.6% Wednesday at 10,272, and London stocks extended losses through mid-session. The pound held around 1.3508, range-bound as investors wait for Thursday's BoE decision and the Fed's call Wednesday evening. If peace talks yield a Hormuz reopening in the coming weeks, the oil shock fades and the inflation scare with it, and the bank never needs to hike. But if the blockade drags into summer, as some officials now openly contemplate, second-round price effects will begin appearing in services data by July. At that point, the bank faces a genuine choice. The forward market says it hikes. The bank's own logic says not yet.
While UK households absorbed the highest petrol prices in years, BP reported profits doubling to roughly £1 billion a month. That tension has now entered Parliament. BP's first quarter results showed earnings more than doubled as Brent crude climbed above $112 per barrel for the first time since March. The company described it as an exceptional quarter for oil trading. SHEL simultaneously announced a £12 billion acquisition of a Canadian rival, the largest deal by a major energy group in 11 years. Energy Capital Partners and KKR launched a takeover approach for FTSE 100 energy distributor DCC, sending its shares up 14%. The message from markets: the energy sector is consolidating and expanding, not retreating. Energy Secretary Ed Miliband called BP's profits morally and economically wrong, triggering immediate backlash from commentators who pointed out that restricting North Sea output ahead of the Iran crisis had left Britain more exposed. UK refineries were asked this week to maximize jet fuel production as the government scrambled to prevent aircraft being grounded. Supermarket chain Sainsbury's joined calls for government energy relief, warning war could weigh on profits. Tesco said uncertainty is already weighing on its outlook for the year. The corporate divergence is sharp. Lloyds banking group reported profits up by a third, but simultaneously took a £151 million hit from the Iran crisis and warned UK unemployment will rise. Barclays absorbed a £228 million loss from the collapse of a specialist lender linked to UK mortgages. High street sales just posted their biggest monthly drop in more than 4 decades. Claire's closed all 154 UK and Ireland stores. Consumer confidence, according to multiple surveys, is in freefall. The Lloyds result contains the logic of the whole moment. Strong headline numbers built on higher rates, eroding at the edges from a conflict that was not in any bank's base case 6 weeks ago. The question is not whether BP profits are morally defensible. The question is whether the spending power that was drained from UK households, through fuel, food, and financing costs, finds its way back once the blockade ends. If it does not, the retail and housing sectors will face a prolonged squeeze well beyond any ceasefire.
The United Arab Emirates announced this week it is leaving OPEC after 60 years of membership. The timing was deliberate. The energy minister told CNN the decision was taken now because the Hormuz blockade would limit its immediate impact on oil markets. Put plainly, the UAE chose the moment of maximum disruption to announce maximum independence. With Iranian and Iraqi oil effectively bottlenecked, the UAE's own production, which flows through pipelines that bypass the strait, can reach markets regardless.
Staying inside OPEC's output constraints at this moment would cost Abu Dhabi billions. The structural significance goes beyond this week. Saudi Arabia has spent years using OPEC as a mechanism to manage global oil prices, cutting production when prices fell, holding the line against member defection. The UAE's exit removes one of the cartel's larger producers and signals to others that the calculus has changed. The IEA chief said this week the Iran war has changed the fossil fuel industry permanently. Whether that is correct depends partly on whether OPEC can hold together without the UAE. For UK markets, the short-term read is next. More UAE production reaching global markets eventually puts downward pressure on oil, but the blockade remains in place, peace talks are stalling, mediators in Pakistan expect a revised Iranian proposal in coming days, with Trump having already rejected an earlier version, and Brent crude continued rising Wednesday. The FTSE 100 fell again, with blue chips leading the decline. The weight of evidence points toward a prolonged energy shock lasting into summer, with the Bank of England holding on Thursday but facing increasing pressure to hike by the July meeting if Hormuz remains closed and UK services inflation accelerates. That scenario is consistent with the gilt market, the IMF's downgrade, and the Lloyds warning on unemployment. But this leaning is only valid if peace talks genuinely stall. If Trump accepts a revised Iranian proposal before May ends, which cannot be ruled out, oil retreats, the inflation shock reverses, and the bank holds all year without hiking. The benchmark to watch is Thursday's Bank of England statement language. If the MPC explicitly rules out near-term hikes, the market's 65 basis point pricing collapses. If it does not, gilt yields will push higher into next week.